Welcome back to the channel. I'm Sturdivant Sr. Today we're cutting through the noise Wall Street is currently obsessed with. Headlines about Iran, global tariffs, and the latest AI earnings. But here on Main Street, we're feeling a different kind of pressure. You've been telling me in comments that you're feeling your drain of the economy and the lack of power in your income. Today we aren't just looking at charts, we're talking about survival. We're going to break down how the global market shock impacts your grocery bill, your retirement, and more specifically, we're going to try to share some safeguard wisdom to help protect your wealth. We're past the jargon. We're just going to talk about some of the issues impacting Main Street with a little bit of the knowledge share from Wall Street. If you're feeling your money is under pressure, you're not alone. We'll coast through this together. What can you expect to cover today on this episode of the podcast? So today we're going to talk about private credit, the crazy run that's happening in the S&P 500 right now that just started, the turbulent month that we just had. So since the war started, we'll also talk about bank earnings. I recently sat down with the Charlotte Business Journal and we spoke about that. So we can talk about bank earnings being down here in the Wall Street South, Charlotte, North Carolina. There's been talks about Trump baby accounts, big topic. And yeah, so here we go. So first of all, let's just go ahead and start talking about the inflation data that dropped lately, right? So this morning we had PPI come out, the March Producer Price Index, PPI, which measures inflation at the wholesale level. So that's inflation that the people that you buy from pay. It came in at 0.5%, which is high, but it's lower than expectations were of 1%. This is the first report since the war started. So this is the first report that we have that takes in some of the geopolitical shocks from the tariffs. I know I spoke about locally around here, it was about $2.81. I saw highs in the $4. Recently, the same gas station has oil about $3.69. So that's 6-7 weeks since the war started. And we see oil hasn't gone back down to that level. Energy hasn't gone back to that level. Don't expect it to go back down to that level that we were at pre-war for a while. Maybe it won't be back there this year. I don't know. I guess it depends on the duration of the war and just what actually happens in the war. We actually saw the blockade of the Strait of Hormuz happen by the U.S. It was enacted yesterday. So one thing to note with that is that when it was initially announced that the U.S. was going to block the strait, we saw the stock market move, the futures market move drastically lower. So everything went down lower, expecting the worst, but then the market maybe priced in that we'd already seen the worst in the weeks before that. The previous week, we were on the brink of bombing Iran with what the president said would be obliteration or annihilation of an entire civilization. I'm paraphrasing what he said, but he was planning on doing his heaviest bombing yet. And then we reached a ceasefire and the stock market really took off. But the market was down. The market since the war started, not right now, but before this rally that we've seen in the last week or so, was down in correction territory in several different areas. NASDAQ was down in correction territory. So when I say correction territory, I mean 10% or more. We saw that down about 10%. We saw the Dow Jones down about 10%. We saw the S&P 500 really close to correction territory as well. Didn't quite reach it, but we see these things happen as the markets start to worry and take in these tensions. And the market moves ahead of investors or macro events, especially micro events. So it's a forward thinking moving index. So the market saw that perhaps the worst was out of the way and it started to recover is what we saw last week after the ceasefire was announced. And then even when it went back and was initially looking to go down from the failed peace talks this past weekend, like I was mentioning earlier, on Sunday night, the futures were lower. Heading into Monday morning, they were in the red, and then we actually finished the day positive. Part of that was because we saw, today we've seen people say that talks can continue maybe this week. We also, like I mentioned, the market's a forward-looking vehicle, so it has already seen this price in, thought that the worst-case scenario would be if bombs start flying. We're in a situation where the bombs, technically we're in a ceasefire, and for those listening, I did air quotes when I say technically. So maybe we'll see an extended ceasefire. The initial ceasefire is 2 weeks, as those listening may already know. Inside of that, we've seen what appears to be the low points for the markets. Have the markets bottom for the year? I don't know. For this session, for this last quarter, yeah, I think we saw the bottom somewhere around March. It just kind of technically looked like it bottom. We saw extreme negative sentiment from consumers. We also saw the VIX, so the volatility index spiked up above 30. And these are things that you all need to see for this market to flush out. Difference between last year, people think that, okay, so this is just like April of last year. It's not exactly like April of last year. And the fact that that market move was based more on tariffs, where it was more of just one party controlling the level of tariffs. The president had pretty much unilateral control of that. Now we're engaged with at least three parties. So we have the U.S., Israel, and Iran. There are other countries involved that have been attacked, but these are the three. And then you have Pakistan, who's helping with the negotiations. But these are the three main countries that are involved in the conflict. So that makes the situation different. Also, the level of recovery that we saw last week. So when we saw the market go down and we saw the market come back up, the increase in the broadening of stocks that went up, I think it was 50, 70% in our like highest bullish rushes day that we had that day, the day where we went up the most. Last year, when we saw that massive recovery after Liberation Day, that number was closer to 90%. So that's still signal like just a broad buy whatever you want to buy type of recovery. Also last year, the market went down lower. So last year, the market went down 20%, closer to 20%, depending on whichever index you looked at during this February through April period, coincidentally the same time frame as this year. But it went down even further in that time frame. You can't expect the same recovery this year. So don't expect it to go back up, from its lows to highs, 60, 70%, whatever it did last year. But that's not to say that you can't expect great returns from what you've seen already. And that's all assuming, so let's look at it in a couple different ways. Let's assume that Iran has reached a point where they're ready to capitulate. Israel, the United States, they all reach an agreement. The ceasefire is extended. The war's ended. The markets are definitely going to, well, I don't want to say definitely or guarantee anything, but the market should respond with a big increase, right? We saw that last week just with the talk of ceasefire, when we announced the ceasefire, how the markets moved. And then when we saw yesterday, as I mentioned, we saw the market start to go down in the futures when they mentioned that the peace talks has failed. But even today, when you hear more news that talks could be extended or talks can continue, you see the market going up. So the market's kind of looking for any reason to go up because it's been so negative. There are definitely parts inside the market that have been oversold. We've had the market below 200-day moving average last month for, 10, 12 days, somewhere in that range. Good things don't usually happen below that average, the 200-day moving average. We've topped that here recently, so that's a good positive sign for the market as well. Speaking about the S&P 500, so we see that increase. And then obviously we're talking about oil, but the oil prices. So let's talk about the oil prices in particular when they spiked last month, or I guess it was initially in February when we saw the spike. So prices were up, $100, $120 a barrel for Brent. So that's oil that's not made in America pretty much. And then WTI, so West Texas Intermediary oil, so that's like U.S. crude. So, and their prices are different. One's usually higher than the other one, and they're trading on different contracts, different time frames. We start to see those two not only go up to $120 plus a barrel, but we also saw them narrow, so they start to even out. But that happened partially due to the difference in the trading of the contracts. So one contract was because they trade in futures. The price that you pay for a barrel of oil today is a price that's pretty much, it had been negotiated. So someone's making a lot of money inside this oil. That's how people make money inside oil in these trades like that. You have stuff that goes up, you have stuff that goes down, but you have people who are making bets on this in the future. If you look at the futures contracts, which is another way some people invest, particularly inside of oil right now, you'll see that the further out you look, those have started to come down. So they're in the 90s to 80s, and I'm talking like 6 months out, So that's those are indicators that the market, and of course, the market doesn't know all. No one's sitting here saying the stock market knows all, or any particular investor or investment person knows it all. But these oil markets are pricing it where the oil per barrel is going to be cheaper than it is now. So you would in turn think that the oil prices and gas prices will come back down. Also, we're in the midterm election year. So you see in midterm election years, the second year of a presidential cycle is usually choppy. I mean, it's very choppy. And the returns are usually not as strong in these years. But what history usually shows or has shown is that after the election and we have whatever decisions we're going to have inside our administration, our government, the Senate, the makeup of that, the Senate, the Congress, the House of Representatives, so all put together, you usually see a rally towards the end of the year. So that could be something to look forward to. As I said, we've seen negative headwinds. We've seen headwinds going into this, obviously the war, and then we had plenty of issues before we got into the war, which we'll cover a little bit later here in a little bit. Like I said, we're going to talk about private credit a little bit more. We'll talk about the banks and their earnings. I just wanted to talk about the S&P 500. So while maybe we're seeing these great, powerful things right now, which, brings me to another point. We can go ahead and jump. We'll come back to the war, I'm sure, at some point, but we can jump into the actual earnings. People say, why is the market going higher with all of these things happening? Why are stock prices up? Because, I mean, if a person did not check their retirement account from the beginning of the war and checked it today or yesterday or sometime during this rally, they wouldn't even have known, outside of like actually knowing what's happening in the world, they wouldn't have known based on their account that really anything had happened unless they just looked and saw the dip inside of it, but they just checked the levels. And that's just kind of how the stock market is. Stock market has started to look at the earnings, which we saw in the first quarter. Now we're in second quarter 2026. We're expecting a new Fed chair. Warsh has been nominated by President Trump. So we expected a more dovish Fed, but we've received, like I said, we've received inflation data today that was really hot, but not as high as expected. So it's just going to make it a little bit harder, perhaps, to jump right in and have a rate cut once Warsh is confirmed. We'll see how that works out. Senator Tillis he still said he's not going to vote for a nominee until Chairman Powell's allegations have been resolved. He's currently under investigation by the DOJ. That's still an ongoing situation. So people were expecting lower rates. They were expecting a lot of mergers and acquisitions, a lot of IPOs, initial private offerings from companies. There were just a lot of different things that people were expecting. Oil and energy costs were low. That was one of the main things that was helping inside of inflation, was oil and energy costs being low. That was one of the big things that went down from the Biden administration to the beginning of the Trump administration and brought down inflation from the levels that we saw in the early 2020s. Now we're in the latter half of 2020s. Yeah. So we still see inside the same spot. We see where the oil, we had the oil that was coming down. We had a dovish Fed coming in, and the stock market had momentum going. We were still in a momentum trade. It was a growth trade. But then we saw a broadening out at the beginning of the year. The equal weighted S&P started to do better. So when people say things like equal weighted market versus the S&P, think of it like this. So the equal weighted market is like, since we're in basketball season, about to go into the playoffs, go Charlotte Hornets. Equal would be more of a team where everyone scores, everywhere contributes. You don't have a player that's scoring 25, 50, 30 points a game, and the next closest person is like 17. Whereas the S&P, most of the indexes that you see like that, they are market weighted. So those are teams where you see the top scorers on the team scoring a lot of places. It's more balanced towards the heavyweights, the Mag 7 in this particular case, which, by the way, as of right now, are positive again for the year, most of the Mag 7. So it's just, like I said, we just seen a crazy recovery. And that was the equal weight S&P. We saw that was looking more of a broadening out trade, right? It was received as a broadening out trade, and the market was just taken as, okay, a cyclical trade or a trade that was just coming, a value trade. We saw a shift from the Mag 7. We've seen software be destroyed this year. Yeah, we haven't even mentioned that software and the SaaS apocalypse. Also, another big thing that we have going on, we've seen a lot of software companies just get destroyed with Anthropic's new announcements or OpenAI's new announcements. Also, companies that are looking to go public this year, which were part of the thesis built into the IPO market, because some of these companies are going to be the largest IPOs ever, right? Just based on some of their pre-market rounds that they're putting out. We've seen a lot of new offerings this year. One example would be Fundrise. I was talking about this with a gentleman on LinkedIn. We were just in the comments. But so full disclosure, I have a Fundrise account. I got that. No, man, it's been a while, 18 years ago. But they had a private credit offering. So where they were going to take a fund public and they offered the fund to shareholders or people who already invested into the side. So Fundrise is started as like a private credit REIT. That's what it was. So retail investor side, and they own properties all across the country. You invest in them, they invest inside the properties, but these are long-term investments. So properties, and not like physical properties, but properties you see inside of private credit to work, right? But one of their funds, they were taking public. They were offering it to people, I believe. Comment, the gentleman bought it. He showed his stub. He bought like $13 a share. And then it went public and it was several $100s a share, right? And that's what people get in private credit. So one of the things people get is when this private credit goes, if you're in something that's going public, once it goes public, you usually see a large windfall in that, right? Sometimes these things are locked up, like initial public offerings with stocks. Sometimes these things can be locked up where you can't trade or you can't sell anything that you were already invested in when you go into these. When it goes to the public market, sometimes it's not. I just think about the SpaceX IPO, which is going to be a little bit different coming up here, where for one, they're allocating a lot more to retail investors. Two, and this isn't even something that companies don't do. I believe other companies have done before where the banks that they're going to use for the IPOs, if they're going to use them, they want them to use their, I believe it's Gronk system or their AI system. They want to use one over there with SpaceX. So, and like I said, that's not exclusive to them. They're not the only company who's ever done anything like that. But that should be a large IPO. I mean, SpaceX is literally going to the moon with some of the things they're doing. Whether or not that stays at that level, we'll see. IPOs generally tend to start really go up. And then once these people who've held these positions for a while sell them, the stock price or the investment price will go down. So the proverbial left holding in the bag is what you'll end up with. So you'll see the stock price shoot way up and then you'll see the stock price come way down. Speaking of things that also shoot way up and come way down, I was talking about things I've been quoting earlier this year, right around when the Dow hit 50,000. I was asked what to do, what investors should do once the Dow hits 50,000. One of the things I said is once the Dow hits 50,000, you figure out if you need to take some of your profits, figure out where you want to rebalance, get some of your profits locked in, because once these indexes usually hit these levels like 50,000, they'll hit them. They might stay there for a second, but then they'll come back down and retreat from those levels. And it may take a couple of times before they'll get back through those levels. The Dow's not back at 50,000 now, although it does look like with this current run that we just started, it may be back there, second half of the year, if not sooner. But that type of thing, so goes up, comes down with the different type of levels. We saw the Dow, like I said, the S&P went up to 7,000. It's back down, but the S&P is less than 1% at the time of this recording back from like all-time highs. So the S&P, the Dow, the NASDAQ, which is a tech-heavier index, for those who don't know, is more focused on tech or growth stocks. We've seen it have a volatile year, but it's seen great returns. And then on some other podcasts I've appeared on, Policy for Normal People with Christy Amato, and then just different podcasts, we spoke about small caps. I mean, we've been talking about small caps for 6 months. Just the run they've been on. Small caps continue to outperform. I think they're up maybe 10% this year. So it's just crazy. And that's just another side to what makes people think maybe this is more of a cyclical rotation. When you see the small cap start to perform like that, you see international, which is pulled back now. International outperformed US last year, right? There could be a plethora of reasons why people may say that. But one of the things about investing is that you should learn to cut through the noise. Invest with your brain. Maybe you want to use a little bit of your heart. There's a theme or something you want to invest in, but don't invest over like political parties. Red or blue will surely cost you green every time, right? So the market's going to go up and to the right if you give enough time. We're sitting here watching the last few years have shown it. These haven't even been real like bear markets that we've seen or corrections. These have just been like, they've been technically corrections, but not like deep, long corrections, which we'll probably do for at some point, but not right now. The market's still running. S&P's in great shape for now. It's looking past this stuff, and that's taking all the geopolitical tensions out. That's just with the stuff that the market was worried about before. So, like I said before, the market was concerned with private credit, interest rates, inflation, unemployment. I haven't mentioned unemployment, but we go back to the software, the SaaS sell-off, SaaS apocalypse, software as a service, SaaS. So we saw a lot of that happening in February. It was like every week we saw something else knocking down another major company or another major sector in the industry. And one of the latest ones was cyber defense. We saw where Secretary Besson and Federal Chairman Powell had to meet and just talk about how powerful AI is with some of the major people and just some of the things that it can do. But it began, it's been widespread. Full disclosure, I custody my clients' accounts with Altruist. So, but Altruist had Hazel come out, and that really destroyed a lot of smaller investors investing, or it's not investors, but investors were destroyed if they sold. Smaller investing and larger investing firms where they thought that Hazel will come in and disrupt the whole or destroy jobs. But Hazel, like I said, Hazel's a tool that helps advisors to better serve you. Hazel's not here to replace us. Hazel's here to help enable us on that side, help us with our clients. So yeah, I guess I should let y'all know that when I'm not, when I'm not in the bat cave per se, when the sun's out in the day, 9 to 5, that's not the real times. But I do run an RIA firm, the ABC Squared. So if anyone ever needs anything. But back to where we at? We're at the private credit. So inside the private credit and the market, how this is all tied together, right? So we saw and it's tied with software as well. We saw software selling off with Hazel. We saw something happen where the legal firms and software, an update came out that took away a lot of the paralegal activities or administrative activities. That was actually the first thing that started way back in February. But we saw disruptions even for people with like inside sanitation. Just AI is going to come through, right, and disrupt things, destroy some jobs, but at the end of the day, will it make our lives easier, improve our quality of life? We'll see. I don't think AI will destroy everything, and I don't know if AI is going to be the be-all, end-all that people have been investing in. But that was another good thing that we saw with this pullback. We saw the market re-rated. So we saw the market multiples contract. We saw some of these companies that were trading at extremely high valuations come back in. So some of these things were trading well above the market multiple historically and their own multiple. So they came back in sectors. As I mentioned, like software, one good gauge of that would be, even though the construct of it isn't the best, the IGV, that's a software ETF. I'm not making recommendations for anything. I'm just using it as an example. But it was above $100 at the beginning of the year. And I think it hit the mid 70s. It started to come back as well. But it has companies like Microsoft inside of it, CrowdStrike, which is a cybersecurity play, Snowflake, Adobe. It has companies like those. Those companies took a major hit in the sell-off for the software as a service part of the company. Those companies took a major hit. So that index came really far down. And at the same time, we saw semiconductors recently come down, but they're starting to come back. So like NVIDIA's, Taiwan Semi, we saw companies like that. One company that sticks out is Intel. Intel, and once again, not recommendations, but I'm talking about companies and companies and articles that I've already spoke about, but there was an article over a year ago speaking about the bull case for Intel. Intel's kind of fulfilling those criteria to see the acceleration and their growth inside their company, right? They do have a partnership with the government, however you want to put it, but they partner with like NVIDIA, and there's other companies like Super Microchip fumble the ball. They seem to be right there to pick it up. Intel's definitely been making strides here. So shout out to an American company like Intel. Big props to them. But that leads into, so we had the software, and then we had the private credit risk that everyone was worried about. And private credit is confusing. It's not something that people really talk about a lot. There are different instruments inside private credit and private equity, but it's really the way that Main Street has been funded here for a while. And it really took a big growth after the 2008 banking crisis. I have some videos on my channel about private credit that breaks these things down a little bit further. Also have some articles with Business Insider where we spoke about private credit, things that may be included inside private credit, inside your 401ks, such as crypto and assets like that. Those are out there. If you want to take a look, I can put them in the description as well. But with private credit, one of the things you have to realize is that there's going to be gates. So there'll be gates. So there will only be a certain amount of money that you can get out, or there's more of maybe a cap, usually around 5%. So if you want to request a redemption out more than that from your fund in 1 year, say you need 10%, or say you want 10% out of it, they'll probably tell you no, because it's set up where if you can only take 5%. Gate it that way so that the investment can grow, because most of these private credit investments are longer term investments. So if you're planning on investing inside, if you need investment in return, or you need your money back liquid within the next, 2, 5, with private credit, maybe 10 years, you may want to wait and not invest inside private credit, because these things work best and you get better returns. Some private credit offers returns monthly, quarterly, annually. Some only offer returns once they sell, or once they close out a fund, or they need a fund that will say, okay, we're going up to a certain seed round. Let's say $10 million. Everyone gets in. Once we get $10 million, we'll lock it up. And this fund runs for 2 years after that. And that's where we're going to pay people, 5 years or 7 years. So that's the strategy been laid out. People sometimes, especially what we saw with private credit fiasco here to begin this year, people were trying to redeem more money. Some of the stuff that the private credit funds had inside these loans were trash. Like, let's just be honest, some of the stuff that they have, it's not to the quality that it needs to be. So people start seeing this and start pulling back the fall. People were confused because they didn't know what they were investing in when it came to private credit. And that could be a lot of things. Like you could be invested in the car wash down the street, or someone building out their local basketball program, or it's just small Main Street businesses that are usually affected with private credit. But a lot of these software companies had private credit exposure. Like we even think about Oracle. Oracle had its private credit exposure, or people worried about how they were going to fund their investments, and we saw that stock take a hit. We saw that stock take a hit from the beginning, from the end of last year until it's starting to grab some footing back now. But it was dead money or just a falling knife here for a while, just straight down. And once again, not making investment advice, but also talking about things I've spoke about in articles. So Oracle is something I also spoke about, a company in stocks, with it being dead money. I also talked about it on here with Samuel Brink. We did a Business Insider podcast episode. So if you want to check that out, it's on the podcast as well. But also, just to continue down, so private credit, so the money's locked up, it's gated. And then at the end, you can get the entire windfall, assuming everything worked the way it's supposed to. And like I mentioned, there's higher risk inside the private credit. So you should seek a higher return. One of the trade-offs, risk versus returns. There are other filters you can look at. Obviously, you want to look at the tax consequences whenever you're making an investment. You want to look at how much of an investment you can stand to lose. Those are the type of things that you need to look at whenever you're making any type of investment. But with private credit, and then some of these private credit funds are only available to certain people. So accredited investors or qualified investors, folks maybe who are earning over $200,000 a year or have $300,000 liquid, not counting their home and their net worth, or $1 million. Some of these funds only let people in with $5 million. These private funds can set themselves where they can self-select whomever they want to let inside with those type of guardrails. So they can make access to private credit a little bit harder. But in my opinion, what we need to see, and I've said this a couple of times as well in print, is that we need to see the banks come out and all these people with private credit. We saw it with Wells Fargo. Wells Fargo saw an increase inside of their investing, but they were missing, and people were concerned with their exposure to private credit. They have one of the largest private credit exposures of domestic banks here in the U.S. I think they reported like $36 billion. And that caught people off guard. Wait till you see Bank of America come out, because they have a lot of private credit as well, private credit exposure. But these companies fund small businesses. A lot of Wells Fargo was in software, obviously. So we see software. And then tying it back to Oracle, not the Wells Fargo help fund Oracle. They're concerned. People were more concerned when it came to like their deal with Anthropic. Wondering if Anthropic would actually have the funds to be able to pay for this. People worry about circular investments inside of AI, and if these companies are actually going to have the funds. But based on the first quarter reports from these companies and corporations, they're increasing their CapEx, which made some of them go down, their capital expenditures, which made some of their stock prices go down. They're saying they can't get enough invested inside of AI right now. Guess what? Some of these companies that are heavily invested in AI are going to miss. They're going to miss it terribly. All these companies are not going to make it. Right. And I mean, like some of the big ones probably are going to be gone because of AI. Because some of the investments they make are maybe the wrong way they invested. Maybe they waited too long, or maybe they invested too heavily. We'll just have to wait and see how that plays out. That's one for history. But these private credit funds need to come out, and firms should come out, and alternative asset managers tying back to the private credit and going into 401ks, different type of investments that are going to be available. They need to come out, let the world know, like just write off some of these investments at the par value that they are. So the book value, they probably have these all marked at $1, but they know, or a fair market value then, but they all know that all these investments aren't fair value. They just can't be. Like the way they put these things together, some are higher quality investments than others. Then you put them all in a package and you can end up with some trash. Once again, back to the T word, back to trash. So inside the private credit we'll see that. And then you have, like I said, the lockup time. So if you don't have a time frame, a time horizon to be able to invest inside private credit and wait, then maybe you shouldn't be going to private credit. Something that also noted, and be careful with your private credit inside your 401ks, is becoming more accessible, is that as we saw all these headlines and everyone talking about how dangerous private credit was, we saw a large inflow of dollars into private credit. So people, and these are like institutional level investors, larger investment amounts. So people are being scared, running from private credit and telling you this on one side, but on the other side, they're also investing in private credit. We've seen that before. Think about real estate. But anyway, so we're seeing that move with people with private credit. Private credit seemed to found a little bit of its footing. Maybe it's just gotten so lost inside of the war and the other things that happen right now. People with affordability, just but with private credit, just remember that's an instrument that's designed to work for longer term investing. It's not something that you should just jump in and out of. It's not money that you should have that you need to use quickly, I should say. It's not a very liquid fund, most private credit funds. So if you jump into private credit, it's probably not liquid and it'll be locked up for a while. Another thing to talk about, today we had, going deeper into the data, we had the IMF, International Monetary Fund, come out and say that they cut they did cut global GDP expectations and get these numbers. They cut the global GDP expectations, the growth, so it was lowered down to 3.1 from 3.3. U.S. growth was cut down to 2.3. And they said if there wasn't a war going on, they probably would have left it the same or increased it, right? So that's telling us that the geopolitical tension, that's just a sign that's showing us right there that, yeah, it is actually playing a part inside of what people were saying. Maybe the global outlook is that this conflict will last longer, oil prices for higher for longer. Like I said, I don't think they're going back down to the $65, $70 a barrel they were at when the conflict started, but hopefully they don't stay above 100 forever, because those prices are just too much for consumers to deal with right now. Affordability is a real issue for everyone down here. People just notice it. It's a conversation I was having with my wife the other day. She's like, these bills, are we using more? And I'm like, no, we're not using more. It's just that everything costs more, right? So we're not using more. We may actually be using less in some things. I know we are, right? But everything costs more per unit now, especially energy costs. We just had what everyone, it was a beautiful winter. We had some big storms come through here. Luckily, personally, we didn't have damage around here. I know a lot of people did, but it was a fun time to play in the snow with the kids, those type of things. We hadn't had snow here in like that in decades. But when that power and gas bill came, it's like, whoa, that's a lot more. Yeah, that's just, So we did use more, but the cost of it was actually more per unit as well. So that's just, and then people, gas, people have to drive. We're seeing higher tax refunds this year as a result of the One Beautiful Bill Act, but I think estimated maybe $1,000 higher, but that may be going into people's gas tanks. Probably not the entire $1,000, but people are definitely seeing more at the gas pump. And I think gas prices, as everyone knows, are elevated from this year versus last year. So there you have people being hit from affordability from both sides, as wage growth hasn't particularly grown to keep pace with inflation this year. So you see those two things just pushing back and forth. The job market staying steady. Treasury yields, so that's another place where people may have wanted to seek safety in during this war and these tensions. They've stayed pretty steady. Like I mentioned a million times before, I look at the 10-year and it's been, 4.17 to about, it got up to like 4.5 during the heights of the tensions so far, but it's back down, 4.2, 4.3. So it's been really range bound here for a while. And that shows that people aren't paying as much for the risk. So maybe they're not seeing as much risk in the long term in investing in the USA. And the movement, it shows that on the long end, that it's expecting the conflict perhaps to not last as long as we've seen before. So yeah. Another thing we've seen defense stocks grow. Obviously, and not defensive stocks, but defense stocks in particular, as missiles fly, stocks go higher. That's a bad and sad truth, but it is also truth that we deal with in the world right now. So we see the initial shot, like I said, where stocks went lower, but stocks may see all-time highs here, this month. I don't know. New all-time highs again this month. It's just a recovery, and it depends a lot on the negotiations that we have inside with Iran that are coming up soon. So it's just a lot going on inside the markets with your money and different things. We talked about private credit a little bit. Let's talk about the banks and some of their earnings. Cool, yeah. So down here, Wall Street South, we have a lot of banks, big banks. Like I said, I was talking with the Charlotte Business Journal. Big shouts to Simone Graham, Charlotte Business Journal. But we were talking yesterday about bank earnings. We're doing our quarterly call. If you want to see anything to say about banks before, you just go check every week when banks earnings are reported in the short business journal. It's there. But so some of the questions she was asking, they were concerning what did I expect from bank earnings. I said I didn't know if banks would give one set of per se guides. I figured they would give, different scenarios. Once again, if the war is short term versus if it's long term, how they plan on absorbing this price shock. What will they see? Where are they seeing? So, and how can they make money banks always make money. Well, how are they going to make money if interest rates do go down? These type of things. So, and I think the banks down here, especially like Wells Fargo, could see increased investment as they had their investment cap lifted at the end of 2025. And when we look at it, we saw that Wells Fargo, they missed and part of it, but they beat some of the areas. So it had a mixed report from Wells Fargo, but their investments were up, just kind of like what we talk about. Always am interested to hear from Bank of America as they have a really good pulse on the consumer. They report soon. A very good pulse on the consumer, and they talk down here with Main Street. So they invest in local communities as well. But once again, like I said, banks are going to continue to make their money. The earnings have been strong, but then you see a bank like Goldman Sachs, or you see a bank like JP Morgan, who had, different sets of earnings. Both were down after their earnings reports, but both kind of fought back from those earnings reports. So we've seen investment, we've seen volatility. So like when volatility happens, these companies are making money, these banks are making money from their earnings inside there. As trading volumes increase, they're underwriting some of these trades. These are just different ways that these investment bankers and banking are making money and returns. Obviously, mortgages and home buying are a weak sector right now for banks. We've seen just housing be a problem, but it looks like even if we don't see interest rate relief soon, we'll see housing supply continue. So housing supply, some relief there. We could see some relief from the housing supply, which hopefully could influence people to invest in buying homes. There's just a new dynamic also where people are starting out later buying homes. It's affordability, is it lifestyle, is it just a different generation? It's just part of what we're seeing inside of the world today, particularly in the USA. And then we also see parents helping their children, like helping their adult children financially. So these are all things that are reducing home ownership, but also reducing bank levels and retirement saving accounts, but the investment volatility and then like these record returns are making the investments grow, if that makes sense. So banks, like I said, banks are they had a mixed quarter, last quarter, first quarter, but their stocks took a really big hit. Like financials was one of the worst performing sectors in the first quarter. Financials really took a big hit. Technology. So the sectors that did really well in 2025 really took a hit going into 2026 when we saw the rotation. We saw energy do well, and energy has been a laggard forever. Gold continues its run, even though gold has pulled back drastically from its meme-ish type parabolic run that we saw last year. It's still appreciating, it's still growing inside of investment. People are still buying gold. They're still seeing gold as a flight to safety per se, a little bit, a hedge maybe. Some people are saying now maybe the best hedge against inflation is actually investing in stocks, since stocks have become so cheap compared to their historical averages. Stocks have come down and compared to the market multiple. But so we see people investing inside there again, or a little bit more. Also inside the stock market, we're seeing also inside with the big banks, we have seen net interest margin has come down. So interest income is coming down. Like I said, inside the trader, what they're getting money from, their investments with their banks, their returns on deposit accounts are down. As I mentioned, people are spending more money. Affordability is becoming a thing. So if it's costing you more money to buy, we've seen credit start to get extended. People are using credit for more things, which if you're a bank that has a credit card, think JP Morgan Chase, one of those banks like that can actually help you, or Citigroup, one of those type of banks. If you see increased volume there with credit card spending, as opposed to people spending their actual, spending their wages, spending their liquid savings, and then just the general outlook in general with banks. Like the private credit was a really big thing. I think that's going to show up in more and more bank reports. People want to know what these banks, how much exposure the private credit banks have, and what they're investing inside is private credit. What's the return being inside of private credit, and how safe are these investments? Like, what's the beta on these investments with private credit? These are some of the key things people are going to search for when it comes to banks and banks' earnings. Opinion. And then they're also going to obviously look for the forecast and guidance. I think JP Morgan reiterated some of their guidance on certain things. And like I said, stock went down. You see banks give a good pulse for Main Street, some of them. Like I said, Bank of America's one that gives you a good pulse on Main Street. Are consumers still spending? Consumer sentiment report comes out. Consumer sentiment's dipping, it's really low. And Bank of America comes out with their data that shows actual consumer spending, credit card spending data. And people were spending at record levels, record highs. Once again, is this record spending due to people being confident, or is it due to things costing more? Or is it due to an increase in cost, I should say? Is that playing more of a factor than people tend to weigh into the actual increases that we've seen? So prices, we just saw the PPI, like I said earlier today, of where the prices was, the index was higher than last year, but lower than expectations, like a lot lower than expectations. Like I said, I don't know if that's like really something to jump up and down for, cheer for. People are still feeling it. I know everyone feels it when we go and swipe a card to pay for gas or to pay for groceries or to have lunch, whatever you may be doing. It's just things are a little more expensive right now. So while we're seeking the end to just know where we're at in this conflict, or what's the outlook, how long will these things take before they're actually resolved? Talk about some of the things that I've been talking about here with the media here lately. So like I said, we talked about PPI, International Money Fund. We spoke about that. Obviously, financial literacy is always something I'm speaking about. It's a big topic for me. It's a very important thing. Financial literacy, been talking about budgeting, and budgeting is a big thing as well, especially with people right now in a situation where affordability is being pressed and every dollar matters. I've said on some videos before, I do have a affiliation with Monarch Money. I can leave a link here. Monarch Money is a good tool for budgeting, personal budgeting, if you want to share it with your significant other, if y'all want to see your budgets together at the same time, if you want to use some of the great AI tools that they have in there to help you enhancing your budget. And if you want to share it with your financial planner advisor like myself, I can also help you with it in real time and help you with questions, sometimes like maybe, can I afford to do this, or can I afford to do that right now? Can I buy this? Can I buy that right now? People never want to hear no, but maybe no, you would need to move this. Flexible budget is one of the options that has in there. And then also has like a static budget. So it has some good things inside there. And if you want to check out Monarch Money, like I said, I have a link I'll leave in the description. I think a free 7-day trial, or 50% off the first year. If you do use Monarch Money using any link or anything I provide, I can be compensated for that. Like I said, I have an affiliate deal with them. But so yeah, I do like Monarch Money for that. Not for the affiliate deal per se, but for the AI, for the way that it helps people with their budgeting, for how it helps people work together to do budgeting. Is just eye-opening for people to see these type of things, your budget, all your expenses. So yeah, you can link different bank accounts. You can link your investment accounts. You can link a lot of things when you use Monarch. Once again, the link's in the description, and it's on my page. So Monarch Money, 50% off first year. This jacket don't want to come off. And a free 7-day trial. So check it out. Check it out when you get a chance. Check it out from this podcast. Check it out from this video, wherever you may be watching it. Budgeting is a huge thing. Also, speaking about budgeting, it was in NASDAQ, it was in Yahoo Finance, and they were talking about like budgeting, the best day to budget. People have all these bad days. One of my comments was, the best day to budget is arbitrary, in the sense that the best day to budget is going to be whatever day works best for you, but you do need to have some type of set day to budget. It doesn't have to be every like Monday or the 5th Tuesday or whatever, because some people work different jobs. You have firefighters who work jobs where they may be working X amount of straight hours, 100 straight hours, where firefighters work 7 days. I don't remember what firefighters work. I know a few of them though. Sorry to my firefighter friends. Some of y'all holler at me and educate me on that, your shifts, how you work. But they may be working long shifts and it may end up with different days. Or I do know people who work like at companies around here like All That, or, at big companies, and you work swing shifts. So they may work 12-hour days, but they may work Monday, Tuesday, be off Wednesday, Thursday, work Friday, Saturday, Sunday. Then the next week, be off Monday, Tuesday, work Wednesday, Thursday, be off Friday, Saturday, Sunday. So if you work one of those type of jobs, you can't just say, I'm going to do it every Wednesday or every Thursday or every, because your schedule is going to change. Your brain won't be sharp enough to do that. So just budget, know where your dollar's going. Cash flow is very important. And once again, Monarch Money is a good tool for you if you want to check it out. Check out Monarch Money and hopefully use my link if that's something you want to do. Trump accounts. I've been talking about these Trump accounts with people for, I don't know, almost a year now, maybe a little bit longer than a year. And I know they're just popping up more in the media more recently, but Trump accounts, these Trump accounts, and specifically the Trump baby accounts, been talking about. There's a lot of articles in the media that I've been featuring and quoting with those if you want to check them out. But big things, I also have a really good, like a straight how to do it guide video on my YouTube channel. You know, it's interesting. It's a tutorial. So, but if you want to sit down, watch it, and learn how to do it, has some views. You know, people tend to like it. But it talks about the Trump baby account, and it goes through and shows the potential growth inside the account, where if you leave it in there, say you have a kid who's born from 2025 through 2028, they'll get $1,000 seed money inside that account. And it shows some of the projections, what could happen if you leave that money in there the entire time, how much it could grow. And some of those projections are astounding. So you just look at it. Versus if you live in it 18 years, 35 years, or 60 years when it's time to retire. You can leave it in there because these accounts eventually, they're just like IRAs for kids. They're pre-tax accounts. So they grow tax deferred. They are only investing inside the U.S., so they're investing inside U.S. funds. Like I said before, kids born from 25 through 28, they get $1,000 seed money from the Treasury, from the taxpayers, but they get $1,000 seed money, and then private individuals can also invest inside it, a private citizen. So we've seen Michael Dell invest inside of this. Him and his wife are making a donation in the billions, which equates to about $250 for any child to go inside their account. And these accounts are eligible for anyone up to the age of 18. So if you're under 18, you can enroll for one of these accounts. You can use these accounts tax-free for college, for buying a home, for starting a business, right? Once you reach 18, those are some of the things that you're looking to do, or once you reach 35. Otherwise, and there are other ways that you can use tax-free, a couple other ways, but those are the big ones. Otherwise, you'll pay a tax just like with an IRA if you take out money, and depending on what time you take it out, if you take it out before retirement age, you'll probably pay a penalty as well. One thing I did learn in the last few months with these accounts is that right now, everyone cannot open up an account. Some of these companies that have employees who audit the actual companies, and they can only invest in certain indexes, big broad indexes. They haven't quite figured out the logistics to it yet, how they're going to allow their employees to invest inside these accounts. So they haven't gotten to that point yet. So there are a couple of the big audit firms, I'm not going to name any of them, but they send out letters to their staff letting them know, don't jump into the Trump accounts yet. We'll let Trump accounts. So yeah, you can go on to the website, sign up for the accounts. They go live in July, but they're a really big initiative. Hopefully they help inform my big passions is financial issues, just letting these kids see that they're invested inside of something, going on right now. Yeah, so sticking with the same theme in investing, what I've been talking about lately with publications and media. So another thing, the concentration trap. There's an article in the NASDAQ on Yahoo about concentration risk. So we're just talking about how people generally own a bunch of household names. They may not realize the concentration risk inside of owning these household names. They're just owning a bunch of one stock versus diversifying outside of one stock or several different stocks. Also, so another thing we talk about is diversification versus correlation. I actually have a YouTube video that's pretty good to dive into correlations and concentration risks, and even deeper into diversification, why diversification works if you want to smooth out volatility over the long run and eventually go up and to the right. Having a good diversification strategy is a good tool. I had an article where we're talking about this. I was featuring him talking about the psychology of money addiction, asking if whether people can be addicted to money. So 4 traits of people being addicted to money was one of them. So that's a pretty cool article to check out. See if maybe you're addicted to money if you're listening to this. Then Social Security versus the market. Like I was saying, earlier in this article, I mentioned that inflation was outpacing COLA, or cost of living, or prices and wage growth. So that's something I was speaking about earlier. And these are all things that I've been talking about within the last 30 days. I mean, if you want to go back further and look and see some of my other market insights, there's all kinds of things we're talking about, but these are just, things that we're talking about the last 30 days. Like even at the beginning of last year, there was a big movement called the No Buy 2025 movement. It's a cool article on Consumer Affairs if you want to check that out, where we start talking about the No Buy 2025 and budget, just financial tools. Those are just some of the things I've been talking about with me here lately in the last month. I also want to just speak about some questions that I got. So we got a question on some of the videos. Like I said, people were talking about diversification. Let's dig a little bit deeper inside diversification, because diversification, I believe, is one of the best ways to have long-term returns, and also reduce some of the volatility in the market. So a lot of times when people think about diversification, they just think about a 60-40 portfolio, let's say maybe stocks versus bonds or whatever. And once again, it's not investment recommendations because everyone's investment strategy should be their own. Everyone's investments are personal. Like what works for one person probably won't work for another person. If you're going to get deep into investments, if you just want to buy an index and watch it go up, okay, cool. Hopefully it's a low cost index if you're going to do that. But with which is diversified, but it's not truly diversified if you own just the only thing you own is one index, say the US index, where we saw last year, international stocks outperform US. So you would, while you still make gains, you would optimize your portfolio by doing it that way. But diversification works also another way inside that portfolio is that everything, and this is why I'll tell my clients, like everything doesn't all work at the same time. Like everything is not going to be going crazy at the same time up, but everything shouldn't be going down at the same time either. You need things that aren't correlated. A stock and another stock, while the two stocks themselves may not be correlated, say one stock is a healthcare company and the other stock makes, I don't know, spaceships. They're probably not correlated. Or one's an oil company and the other's a tech company. They're probably not correlated, but they are correlated in the fact that they are stocks, right? So that's just stocks, which is kind of something that you get with the private credit too. It's depending on what kind of private credit you get. If you're investing inside a company, it's still kind of going to be correlated. But to diversify, you have to have other things outside of it. So not even per se bonds. Bonds aren't exactly diversified outside the portfolio either because bonds are interest rate sensitive. Bonds work better in theory when stocks are struggling, when there's pressure on stocks, or we're in a risk off environment where people are more focused on investing in bonds because the interest rate returns may be better than stocks. But we just saw earlier this year where the market, where people should have in theory gone to bonds for safety, but bonds didn't really perform very well. Stocks didn't perform very well. 60-40 portfolio didn't perform very well. So that shows that those things aren't exactly correlated. Another thing that is generally used as a diversifier is gold. So, and we saw gold once again. You got to kind of toss out this last 6 weeks with the war when it comes to like diversification, even though that's still going to work better than solely concentrating inside one position, unless you pick the right position, unless you maybe own an oil company going into it, you know, pick the right oil company and then you got out of it when oil started to go down. And that's time in the market, which is a whole other thing, time in the market versus time in the market. Time in the market works better with diversification as well. But so you're looking at an alternative asset or something that's truly not correlated. So maybe you're looking at not even gold or maybe even private credit, maybe something like, I don't know, like Louis, that's not something, or some type of real estate. Like those things are not in your total portfolio. So you have to look at your total portfolio. People think of usually their investment or retirement portfolio and they only think about those 401ks or IRAs, but you need to think about everything. How are you going to generate income when you retire? Or these taxes going to be inside your retire? How am I diversifying everything right now? So you need things that are not correlated. So like I said, you'll have the outside of bonds. There are different ways to earn money. You could just have cash. Cash isn't correlated, but cash is going to lose out to inflation every time, especially in the long run. But cash has that liquidity, that liquid aspect to it. But there are other things and I'm not saying go invest in crypto or anything like that, but that's usually not correlated with stocks, even though it kind of moves sometimes with stocks. But it's just an example of what I think its initial thesis with crypto is that it was a diversifier, right? It was supposed to be put in there to decentralize. So one person can't control it, so governments can't control it, so it can't be manipulated, but give anything enough time and people figure out how to manipulate it. So having different things like that, and I'm not, once again, not investment advice. I'm not telling people go out and sell all their stocks or sell all their bonds and go buy private credit and crypto and annuities and alternatives. I'm just saying what you generally think of with diversification and correlation, what you generally think about diversification in particularly. Like if you think you have a bunch of different stocks and that makes you diversified, it makes you diversified inside of your stock portfolio, but it doesn't make you truly diversified inside of your total investment portfolio. So you just need to look at different things and different ways to diversify, ways to generate income, ways to protect taxes, So maybe it's even not, because even inside of a bond, you have different type of bonds that work, right? You could have a government bond, you can have a corporate bond, you can have a junk bond. A bond is paying more because you're taking a higher risk. It all just depends on the spread, right? And when I say the spread, that's the difference that you're getting between, say, a government bond and, like I mentioned, a junk bond or a corporate bond or a bond that's higher risk. What's the difference in that? What's your return for the increased risk. So that's diversification inside that thing. Inside that, I think that gives a good answer to the question from that viewer. Thanks for the questions. And always, if anyone else has any questions, feel free to shoot them down. Let me know about them in the comments. Yeah, this has been a really good, fun episode. Just sitting here, just talking for over an hour solo, Main Street Meets Wall Street podcast. I appreciate everyone who's been sitting there listening. Only a few more minutes, just talk a little bit more about what's happening, what's happening with Main Street and Wall Street. So recently I did we recently released the edition of the Wall Street South Journal on private credit. And it's just a different dive into that. I've seen this as a fall off. It was actually themed, for those who don't know, that's the DJ Cole album. Fall off song called The Let Out. Just one of the main things was thinking of, do you know what you're actually investing in? When the tide comes out, who doesn't have on a bathing suit, to quote Warren Buffett? So that was inside of private credit. We've been doing some pretty cool things with this podcast as well. We've had so far on the podcast, we've talked about the U.S. debt, the cost of servicing the debt, talked about Bitcoin, whether people really think it's a scam or not. Talked about options trading, how people can trade options and protect their income, or if you have a certain market call, if you think the market's going up or you think the market's going down, how options work there, how options work inside of portfolios. And these are just the episodes that I've had guests on here with me. So these aren't just solo episodes. You'll get the solo episode every now and then, but usually I have a guest on. And these industry experts who have been in the game, all these people, 30, 45 years plus. So talking about options, how you use options inside your portfolio, help you with your retirement, or just help you generate income. Like I said, spoken of the debt, Bitcoin, had a guest on who has spent like 45 years institutionally investing. And we just spoke about a wide ranging conversation, what institutional investors do that normal, quote unquote, air quotes for those listening, people don't do, investors don't do, how they're making their alpha as well, some of the psychological things. And on that episode, we actually have a really good conversation on donor advisory funds. It talks about giving back, how you can give back, whether you're with some of your stocks and some of your equities, if you're making gains out here Main Street. It's just it's a wide ranging conversation. Oh yeah, I had Adam Parker on. Check him out. He's on CNBC. But he brought on his speaking about trivariate and trivector research. And on that episode, he offered a free month of his research for anyone who goes on to seek it out. I think it's a couple $100 usually, depending on what you're looking for. If you mention Marcus when you go on there, so say Marcus, Marcus from Main Street Meets Wall Street podcast, or Marcus from the ABC Squared, that's my company. But if you say Marcus, you'll get the first month free. So anyone who wants to look into maybe, there's always DIYers out there. People want to look deeper into it. I'm trying to help people learn more, become better investors. If you want to check and see what Adam's doing, Adam's a really smart guy. He has a PhD. He's a fancy investor guy. But really, if you want to check out his research, check it out there. Another things, like I said, I have the Monarch. If you want to look into budgeting, so there'll be a link there for the Monarch money inside this episode. And trying to think what else we have going on with who else has been on the podcast. We got Samuel, he's a reporter over business side. So we talked about some of the things that people see on their side. We were talking about private credit back then. And then obviously on LinkedIn, you can catch me on LinkedIn. I'm usually posting on there about different things or articles. So when people probably wonder like, why is this guy on here talking? But that's why it's like, I just want to share it. I know a lot of times whoever speaks the loudest is perceived as quote unquote knowing the most or whatever, but there are a lot of things that happen. There are a lot of things that we've been talking about down here on Main Street for a long time before they ever hit the quote unquote big media, or you may never see it, or it may pop up months later. We just kind of laugh at it. But because we've already been talking about looking ahead to it. So, that stuff helps our clients. But just go back when you have a chance, check out the podcast, other episodes that we have going on of the Main Street Meets Wall Street podcast. The Wall Street Journal South, that's the newsletter. A lot of great things going on there. If you want to find me in the media, just check me out. I'm in there quoted for a lot of different things from different, been Wall Street Journal, Economic Times, like I said, NASDAQ, Yahoo, all those different kinds of places, all those places been quoting there with my insights. So if people are wondering like, why is this guy? Once again, that's just why. I just want to share. My main goal is to help Main Street meet Wall Street. So, and we do that by helping break down the jargon, that's out there, help people realize that you got to cut through the noise, right? When investing, like I said at the beginning of this episode of the podcast, like if you didn't look at the stock market right before the war started, and then you just happen to look at it, or you didn't look at your retirement account before the stock market. If you didn't look at your retirement account before this war started, and then you look at it now, but you haven't looked at it the whole time, you wouldn't even know like anything had happened. And there's been a lot, as anyone breathing air and walking around knows, a lot has happened in that time, since that time. So focus on the points like right now, what am I focusing on? What are we focusing on with my clients, with my firm? We're focusing on, like I said, we're always focusing on taking out the noise, letting the noise out. We haven't been making any major moves. We made moves earlier. I mean, we just had to earlier this year when we saw it. You can't go in and out of the market. Stop trying to time the market. Just stay in the market, time in the market. Have your thesis and be positioned, because unless your investment thesis changed during this dip that we had recently, you probably should have been buying it, because all the stuff that you liked at 10% higher, you should love it when it's 10% lower. If your theme is still the same, your investment theme is still the same, if you still have the same thesis on why you're investing inside this company. And if you just know that sometimes everything gets thrown out with the bathwater, and these are still strong companies, an example, and once again, non-investment advice, maybe like NVIDIA. NVIDIA came down where, people were always complaining about its market multiple before, it came down below where the S&P was trading as a market multiple. So that was an opportunity, perhaps. I don't know. Will NVIDIA continue to lead the market? I don't know. But it seems like Intel's running strong. And that's not an endorsement or investment for either one of those companies. It's just showing you concentration. It's also showing you how market multiples can compress, and sometimes how you can see advantages. So that's maybe something you want to look at when you're looking to get back in the market, if you decide to step out. But so yeah, time in the market. Like if you bought the dip or you stayed invested, you're going to see, you've already seen returns. You've seen different positions. If you've been a person who dollar cost averages or just buys into the market every time you get paid to that effect, or every time you have money, you buy into the market, you also will see gains in the long run that'll smooth out some of these effects. So the main thing and the big thing is just stay invested, Main Street. Don't panic. Don't panic sell. It's only a loss when you sell it. And once again, it's only a gain when you sell it. So if it's up and you sell it, that's a gain. People really should never complain about locking in gains. Don't chase the all-time high. Know where you're getting in, know where you're getting out when you're investing. And yeah, I thank you, Main Street, for just sitting here. Hopefully you got some value from this podcast episode. I like the solo ones where I can just sit back and just talk, share what I feel, share what I know, share some data information. Like I said, we're looking close at all-time highs again, but the market could move back down. I mean, the market will dip. There's some more volatility ahead for sure. I will say that there's definitely more volatility packed into this market that we have going forward. Historically, midterm years in presidential elections are turbulent, bumpy, but once you see some resolution to the election, so November to the end of the year, you'll see a run. That's not saying don't be invested until then. One of the things I'm always preaching is time in the market versus timing the market. And when I say that, that means staying invested time versus trying to time it, where people who try to time the market, they'll invest, and when they see the market going down, or they think they'll know when the market's going down, they'll take their money out of stocks, go all the cash, and they'll come back and invest it again when they think the market's going up. Problem with that is there's a lot of problems with that. One, like I just mentioned, like if you just stayed in and you bought that dip, you're going to be better on the other side than someone who went out and say the stock market was where it was in February, or a particular stock. Say you had a stock that was $100 and it went down to like $80. What's going to convince you that it's time to get back in the stock market, right? What are you going to see is going to make you say, okay, all right, well, there we go. All right, now I'm ready to get back in the stock market. And if it's the price, you probably waited for the stock to go above $100 again before you get back in it. So at that time, it's going to cost you more to invest in the same stock. Whereas if you like that stock at 100 and went to 80 and you just bought more of that same stock, you just kept spending that same $100 that you were going to buy for that share, you're buying more shares of that stock, right? So by the time you spend $500, you bought a whole nother share of that stock. And then when that stock goes back up to $100 or $110, whatever level it is, you've increased your position and your returns inside that stock. So stop trying to time the market and timing the market. Also, when you sell stock like this, sometimes they can trigger different tax events, level of taxation, depending on how long you've held the stock, whether it's short term or long term, or there's going to be tax ordinary income. So these type of things all play into the decision as well. People usually don't take the tax factor into it when they make investment decisions or when they sell investments. That's been a big thing when you think back just to the meme stock rush that we had what, 23, 22, somewhere back then, where like the GameStop stuff, where we had that crazy meme stock run. That was 23, I believe. It's after the bear market. But you see that go up, and then people don't have the discipline to get in or to get out. But a lot of those people had a lot of gains, and they sold, and they didn't take into account the taxes they were going to have to pay on these positions. You've seen a lot with crypto too. People don't take into account the taxes they'll have to pay for the gains that they make. Personal opinion, I'd rather have to pay taxes on gains than harvest losses, but every position doesn't go up. Like I said, that's where tax harvest loss can help your portfolio out as well. Also tying back to the diversification and why time in the market versus timing the market. So it's all just different things all mixing together. You can't be afraid of the stock market or investing, especially when historically we've seen that the dollar or cash loses out to inflation over the long run every time. So I think that's what I had to tell Main Street this week. I don't know if there's anything else to drop, which like I said, as we sit right now, oil prices have pushed we'll just call them right around $100 a barrel. They've been down, they've been up. Stock market's come back. It's resurged from nearly 10% down, depending on the index, to within all-time highs again, within percentage points of all-time highs again. S&P's within like less than a percentage point. We had PPI come out today. That was expected to be around 1%. It was like 0.5%. So inflation is high, but it was less than expected today. Take that as you want to take it. I don't know if your glass is half full, your glass is half empty. My glass just has water in it. We also spoke a lot about private credit, bank earnings, and the madness in the market, how it's just going up, led by small caps once again. Small caps continue to lead. The newsletter, the Wall Street South Journal, and LinkedIn and the podcast. It's good stuff. If you need anything, you can find me here on the podcast, or you can find me on LinkedIn, Marcus Sturdivant Sr. with the Main Street Meets Wall Street podcast, owner of the ABC Squared, husband, father, all those things. Thanks for watching. Main Street Heart, Wall Street Smarts.